Right, welcome to this special conversation, a special edition of Business Redefined. I should say, as always, this is the platform that unpacks anything public finance, capital markets, economics and finance for you, for us to be able to make sense of it and what it means for this economy and for our pockets. We have a double dose today. At 7:30, we had a conversation with Safaricom CFO on their earnings. Tonight, we want to unpack matters regarding the finance bill of 2024. As always, this document has elicited a lot of interest and discussion in this country in terms of the raft of measures the government wants to take with regard to mobilization of revenue for the financial year 2024-2025. And just for clarity, that is the period which starts in July 2024 and runs until June 30th, 2025. We will be delving into this subject, and to help me discuss this matter, I have to my right, Kahema, who is the founder of Alpha Tax and Business Advisory Services, a specialist when it comes to matters regarding indirect taxes, that is excise, VAT, etc. Christine, karibu sana.
Asante sana.
Glad to have you here. And on my left, I have ISPAC chairperson for the Public and Finance Committee, that is Robert Waweru, also the managing partner at Ichiban Tax and Business Advisory. Karibu sana.
Thank you.
We will be joined shortly by the chairperson for the National Assembly Finance and Planning Committee, that is Honorable Kuria Kimani. He has assured me he's on his way here, so we definitely do expect him to give us the legislative side and the government side for that matter as well with regard to matters on the finance bill. Now, to kick off our conversation, let me start to my left. Robert, this finance bill is an interesting document in the sense that it signals a number of things in terms of the government's plan for revenue raising for the next financial year, specifically leaning more towards indirect taxes and what we call appropriation aid. So we look at the levies being proposed in one way or another. What are some of your key highlights? Let's start with what's your biggest positive highlight in the finance bill, and what do you see as the biggest challenge in this bill?
Yeah, thank you very much, Julian. And you're very right. This finance bill, as currently drafted, is very heavy on indirect taxes. There's a lot of focus on cleaning up the VAT Act, a lot of focus on cleaning up the excise, removing certain things that were previously exempt, for example. And like you said, the appropriations in aid, the levies. We've seen quite a big expansion of the items that are subject to levies. Now, in terms of the highlights, I think really the biggest winners of this finance bill as currently crafted would be the employees. We've seen quite an effort to expand the items that are exempt from tax, things which some of which we've not seen changed for about 19 years, case in point pensions. But also I think there is an important point around clarity and just aligning with international best practice around, for example, international transactions, transfer pricing. Yeah. A very, very good move is to introduce the advanced pricing agreements, which really has been long overdue. Countries that, like Nigeria, which introduced the transfer pricing after us, they already have those provisions. Yeah. So that really is a positive for businesses.
So those are your key positives in the finance bill. What are your key challenges?
Julian, as currently drafted, first of all, this is not an easy finance bill to read. The changes are quite complex. It's a mouthful even for lawyers. But I think one of the biggest challenges is that some of these sectors are going to be really hit hard. Case in point would be anybody who is dealing with excise. Yeah, that's a big issue. And I'll let Christine talk about the proposed deletion of Section 14 of the Excise Duty Act. But if you look at, for example, people who deal with wines and spirits, the growth in terms of excise duty rate is about 500% for some of those items. It's really, really high. So that's a big challenge.
All right. Let me come to Christine on my right here. Christine, same question. First of all, what's your general sense around the finance bill? Do we have a good finance bill to begin with? And what's your key highlight in terms of what's positive and what do you see as the key challenge?
I think when you look at the finance bill, what you can actually see it's trying to bring the medium-term revenue strategy to life. It's actually also bringing the national tax policy to life. So when you look at those two documents, there's actually some connection with the objectives that were to be achieved in those documents in the finance bill. Some of the provisions are a shocker to us, but some you can actually clearly see. If you look at the objectives, for example, of the MTRS, it was to increase disposable income. It was to expand the tax base. It was to mobilize for revenue. It was also supposed to trend as much as possible and drive compliance. So you can actually see a link to a large extent between the finance bill and the medium-term revenue strategy and the national tax policy as well. So that gives me hope that this is a conversation that has been ongoing. However, as I say, there are some new provisions in the finance bill that we didn't expect. We know the medium-term revenue strategy was supposed to be implemented in phases. So maybe this is a first phase, and we should be able to see another second phase to bring that to life. From a win perspective, I agree with my colleague Robert that the employees have been cushioned to some extent, and that has been done towards increasing the disposable income. So there are different examples we've seen on this. So for example, the affordable housing levy, that was a big one last year, and we were pushing for a cap, and we hoped that the cap would come in this year. It didn't come, but what we are seeing is that that amount that you're contributing to affordable housing will now be an allowable deduction.
Correct.
So you're more or less getting a cushion of 30% of that amount that you've paid for affordable housing. It was at 1.5%. SHIF is coming at 2.75%
of gross.
Of gross.
Yes.
So that will also be an allowable deduction. So yes, you're contributing to SHIF, so it's a painful contribution, but on the other hand, they've scrapped off reliefs that would have been given instead of the allowable deductions, but the allowable deductions accord you a better saving if you compare that to the relief. So there are those pension. For me, I'm very big at pension because the contribution, the allowable deduction has moved from 20,000 to 30,000. That's really, really encouraging because when you look at that cap of 30,000, it's both what the employer and employee is contributing. So you're cushioning the businesses and you're also cushioning the taxpayer. So there are some good things, but there are other proposals that will really hit some specific sectors, mainly in the manufacturing sector, which I hope that will be reviewed as we get into the phase of public participation.
Christine, allow me to stay with you on this. I actually think one of the biggest winners in this finance bill is the pension sector. And because of a number of things. One is what you just mentioned, the increase in the allowable deduction from 20,000 to 30,000.
Yes.
The second one is this country has for a long time been speaking about the provision of exempt, such that once you do your pension drawdown, then it is still tax exempt. But I have a question for you, and the skeptics have said, look, even if you're increasing the allowable deduction from 20,000 to 30,000, how many Kenyans in the labor force actually make a contribution of this quantum? What proportion would actually benefit from this? And in a market where out of every 10 employers, 7 are in the informal sector, don't you think we should have rethought this proposal?
Okay, I think the idea, Julian, is to encourage saving through pension schemes. So for example, as an employee, I agree with you. Maybe not too many employees will be able to contribute such significant amounts to a pension scheme. But remember, even NSSF has increased. So the limit of 20,000, part of it is already being taken up by the NSSF contribution. So it's actually just giving the employee an additional amount that they can claim as a deduction, and also not punishing the employer. Because when you look at the 30,000 shillings limit, is a combination of what the employee and the employer is contributing. So for example, if the employee is contributing 20,000 and the employer is contributing another 20,000, previously what would actually, in the current law, what would normally happen is that the 20,000 will be an allowable deduction on me as an individual, but what the employer has contributed will be added back in the tax computation. It will not be allowed. But now, because of the increase, it's cushioning the employer as well to also encourage the employer to contribute for you. So that's one of the benefits coming out of this. And you talked about exempt tax. So one of the other changes that has happened from a pension perspective is our own withdrawals. So currently what happens is, because you were allowed the deduction upon contributing, upon withdrawal, you'll get a certain tax-free element, that's 60,000 for 10 years work, to about 600,000, and then the rest will be subjected to tax.
Correct.
One of the provisions that has come in is that If, for example, you've been in the scheme for 20 years, and 20 years really move fast. I mean, if you started contributing at 30 years, at 50, you can contribute, you can withdraw, it will now be tax exempt. Yes. So that's actually encouraging taxpayers to hold in the investments in there, because we've seen a lot of guys trying to withdraw before attaining the retirement age. Yes. So now you're being encouraged, just hold it. Because I think what government is trying to do is to ensure that even in old age, there's less dependency on government, and taxpayers should be able to fend for themselves.
All right.
Yeah.
Robert, any take on the issue of pensions?
Yeah, absolutely. And I agree with Christine. I think if you look at this country, one of the biggest investors in terms of government paper is pension schemes. So it only makes sense that you encourage people to save into these pension schemes, and then they can invest in government paper. So you're sort of mobilizing savings. And don't forget, by the way, that Kenya has been cited as one of those countries with a very low national savings culture, or national savings rate. So what you're trying to do is encourage people, let's save now for future. And some of these things, you can see them replicated in the essence of this finance bill. If you look at post-retirement medical schemes, they're being exempted from tax. So essentially what the government is telling you is, we're going to help you so that in future, like Christine says, you're not too very dependent on government. And I think that really is a good thing that we need to applaud government for.
All right. And Robert, as you make that comment on the provisions around pensions, we will shortly be welcoming on set the chairperson of the National Assembly Finance and Planning Committee, that is Honorable Kuria Kimani. He'll be joining us shortly. But as you say that, Robert, you've mentioned something very important: investment in government paper, largely done by pensions. And for the sake of our viewers, government paper is largely treasury bonds. Two provisions here. One is there is an amendment which then brings an aspect of withholding tax with regard to infrastructure bonds. Maybe the clarity we need here is, to what extent would it apply, especially when you talk about pensions and their investment in this space?
Yeah, that's a good question, Julian. And one of the things that you'll realize reading this bill, the pensions are still tax exempt. So even when they invest in this government paper, irrespective of whether they're investing in IFBs, infrastructure bonds, or normal bonds, pensions themselves are still tax exempt. And the idea here is that you want to maximize the return or yield for the pensioners, so that at least 20 years down the line, like Christine is saying, they can go home with something. So they're still exempt. However, you and I, if we invest as individuals, if we invest in this paper, then there is now 5% tax going forward. That is for bonds which have been issued now effective 1st July 2024. So I think government is signaling that as individuals, yes, we are still inviting you to invest, because interest is generally subject to tax at 15%. So we are giving you a haircut of 10%,
yes,
but certainly not as much as we are encouraging pensions to continue investing. That's my view.
Great there. And ladies and gentlemen, let me now welcome Honorable Kuria Kimani, the chairperson of the National Assembly Finance and Planning Committee. Mheshimiwa, karibu sana.
Thank you, Julian, and it's great to be back here. We had a similar conversation, I think, a year ago when we were passing the discussion about the Finance Bill of 2023, now the Finance Act. It's amazing. Interestingly, we are the same panelists. So I think the same thing repeated itself a year later.
Yes.
I was watching you live on my way here. I think this is when I lose my life up to when the budget is passed. On one hand, trying to, how do we see that we raise the revenues? And on the other hand, how do we balance now as a State Department of Finance and National Planning, how do we do the budget on our sagas? And maybe from the onset, I like the robust conversation we have on the finance bill. We are talking about what are the taxation measures that are being introduced, who is hurting what are the benefits or the gains. But Julian, what is really interesting is that a similar conversation should be going around on the estimates.
Yes.
Because at exactly the same time, two documents were submitted to Parliament, to the National Assembly.
Yes.
The estimates
and the finance bill.
And the finance bill. But now, Kenyans now really like talking about the finance bill, but they don't talk about the estimates.
Yeah.
So, for example, tomorrow we're running the advert on receiving views from Kenyans on the finance bill, and I assure you, there are going to be thousands of people sharing their views on the finance bill. But at the exact same time, is an ad that's going to go out on give us your views on the budget.
On the budget.
No
one will send.
Nobody's interested.
but Chairman, let me hold to that point. And just before you walked in, we were actually giving you your flowers on this finance bill.
Okay, thank you.
In the sense that it has significant wins when you talk about employees in terms of allowable deductions. You can look at pensions, you can look at mortgage. And maybe just give us, very briefly, your introductory context around how you arrive at this trade-off in terms of the give and take within the macroeconomic context.
The last 1 year has introduced a raft of measures on amendments to the Income Tax Act. And I think the fundamental ones are two. The Affordable Housing Act, now the Affordable Housing Levy, and the Social Insurance Hospital Fund. So what you've been able to study is, because one of the things that we do is that after passing of these tax measures is look up and say, what is the impact compared to what was the intended impact, and what has that led to the general macroeconomic policy of this country? And I dare say the introduction of affordable housing levy and SHIF at exact same time has reduced the disposable income of the employed Kenyans. And we got to receive this feedback a lot, especially when we're doing the national tax policy. When they're saying, first of all, even the tax rates that we have on the employees is actually even higher than the ones we have on SMEs in corporations.
Yes.
And now people are asking, do you want to punish us just for being employed? And say, now, wait a minute. So how do we make sure we cushion these people? And that's why now we carried this along in the national tax policy, and this we have again carried on in the finance bill, which we're saying now that these statutory deductions, the affordable housing levy and social insurance SHIF, are now going to be tax allowable for income tax. Yeah. So what this will do is that it will mean more disposable incomes or more money to the pockets of especially the salaried people, and consequently you are likely to see now an increase in the other in consumption taxes, such as VAT or an excise duty. Because now when I have more legroom on my payslip, now I can buy something else and I can spend, and that will actually, the multiplier effect of that is that you will actually see an improvement on the other consumption taxes like excise duty and VAT.
Chairman, let me hold you there as we take a very quick break. Now, coming back, he has touched on the issue of indirect taxes. The finance bill cleans up the VAT Act quite thoroughly. We've got developments in excise. We'll be unpacking that for you, so stay tuned. Welcome back to this special conversation on Business Redefined. We are unpacking the Finance Bill 2024. We have the chairperson of the National Assembly Finance and Planning Committee, that's Kuria Kimani. Once again, welcome. We have Christine Kahema, founder, Alpha Tax and Business Advisory, and we have the chairperson of the ISPAC Public Finance Committee, Robert Waweru. Karibuni sana. Gentlemen and lady, before the break, we were unpacking the green shoots in the Finance Bill. We talked about the allowable deductions, whether it is affordable housing, whether it is mortgage, whether it is health, when it comes to matters health. Chairman, let me start with you on this one. Help us understand where we are coming from with the motor vehicle tax.
Thank you very much. And again, we seem to be back where we were last year. Because even though the Finance Bill, now the Finance Act of 2023, had a raft of measures, including tax amnesty, now where we have now 640,000 taxpayers who are blacklisted, now seeing the green light through the pardon of their taxes, where we have 22.69 billion shillings being collected as additional revenue, where we have taxes forgiven up to 247 billion shillings. But we reduced the finance bill conversation of last year into two items: housing levy and
VAT on fuel.
And VAT on fuel. And unfortunately, we seem to be back again on the same cycle, where we're saying it is motor vehicle circulation tax and I think VAT on bread. And there's so many other measures that are on this finance bill that we should really have a conversation on. And even before I answer your question, when we're talking about this finance bill, I really urge Kenyans that the Kenyan budget, or budgets across the world, are twofold. There is the expenditure side and there is the revenue side. So the Budget and Appropriations Committee now is doing public participation on the supplementary budget and the estimates for 24-25.
Yeah.
And they're going to 22 counties, I think. And what are the counties saying? We need roads, we need dams, we need schools, we need this, we need this, we need this. Nobody's saying cut anything. But we, on the other hand, want to have the same conversation about that budget, but remove this, remove this, remove this. And sometimes I have such a hard time, which I shouldn't, because it would be much easier if we just cut the budget. But Kenyans don't want the budget to be cut. They want to have roads, they want a free education, they want all these systems going in place. And I really urge that even when you're having a conversation about the revenue-raising measures, can we go hand in hand with what is in financing and interrogate what are these money going to do, and look at the quality of expenditure, the quantity of that expenditure, and the benefit accrues to us, so that we are able, through public participation, to say that road project is very nice, but it can wait.
Yeah.
That is very good, because ultimately what National Assembly do is take the views of the public. On the motor vehicle circulation tax, we have the road maintenance levy, that's paid on everyone. And ideally, the logic behind road maintenance levy is a user pay system. If I use a road, definitely there's going to be TNW on the road. So I should be the one paying for that road to be repaired. And the person who is walking or who doesn't have a car, then they shouldn't be paying. But what you've seen over the years is that the increase in the number of vehicles that I know on roads have not led to, even though it has led to an increase in the road maintenance levy, the increment is not sufficient to maintain our roads. And that's what you see now. As a result of floods, go to any highway, and our best maintained roads over the years have been the highways. Now you find all our highways, Nairobi-Nakuru highway has potholes now. Yeah. You see Thika Road has potholes. You see Mombasa Road has potholes. And the amount of money we are collecting on the road maintenance levy is actually not sufficient to maintain both our highways and our rural roads in the village. So you're asking yourself, then how else can we do this? Should we increase taxation to people that are not using the roads, or should we make it a user pay fee, where like the SGR, not the SGR, the expressway. If I want to move faster and have a good view, then I will pay for the expressway. And the same thing is saying that we are the ones who are leading to the increased TNW on our roads. And so we should be the one paying for it. So that is the brain behind, or that is the thinking behind the motor vehicle circulation tax. So if I don't use my car, I don't get to pay. But if I use the car on that road, it's only fair that then I be the one to pay for the maintenance of that road. A second concern has been, we're all talking about climate change. We're talking about floods. We're talking about, for the last 1 year, the causes they present Molo, we've never gone 6 months straight without rains.
Yeah.
But last year we went for 6+ months without rain. Drought, it has never happened. Immediately after drought, we have floods. And our meteorological department is saying that it's likely that after these floods, then we're going to have another drought. Why? It's because you're not taking care of our environment. Why are we not taking care of our environment? The wastes from vehicles, for example, the emissions from our, especially from our gasless and from our diesel cars and petrol cars, all that is what we're saying. Let's go away from what my expert colleagues were saying, indirect taxes. Let's have, if I am the one polluting, if I'm the one using the service, let me be the one to pay for it, and not someone who is not using that service.
Chairman, let me ask you a very quick question, and I'd like a very brief answer so that I come to Christine and Robert for their takes on this matter. Is motor vehicle circulation tax an income tax or a wealth tax? And why I ask that question is because the amendment is coming via the Income Tax Act. But it looks like you are targeting persons perceived to have wealth by way of a car. Where does it stand?
I would say it's a hybrid between an income tax and a wealth tax, and trying to factor in a user pay tax, like a levy or what do you call ANA. Why are you saying, fine, I don't want to pay the motor vehicle circulation tax, fine. Then don't use a car. Like we're saying, I don't want to use the expressway, fine, so don't pay for it. Go through other means. And essentially, the long-run import of this will be to encourage investment in elaborate public transport. You know, if you go to economies that are slightly ahead of us, there is a very efficient and elaborate public transport. Every time there has been an attempt, even where we have had huge investors wanting to invest in our public transport through private-public partnership,
yeah,
the feasibility studies have shown that we like to drive our cars so much that we're not able to attract serious foreign investment on our public transport. Why wouldn't we have rail transport in Nairobi City? If I'm commuting from Westlands or from Kikuyu or from wherever to here, why do I feel the need to drive my car? It is because we do not have an elaborate public transport. And you've seen this method being tested across very many countries where when there is incentive to have an investment in public transport, there has been either government investment, but most of the time it is a PPP agreement. You saw a few years ago trying to have this quick lane on Thika Road. We're calling it the
BRT.
And a lot of investors had lined up to invest there. But when it was set up, then people said, there seems to be a behavioral issue in Kenya where if I sit in a matatu or I sit in a public transport, then I don't seem as bougie or as, where I really want to drive my car. So in the long run, and I'll quote this example too, the last finance bill, we introduced zero rating of assembling of electronic motorcycles, yes, and electric bicycles. And now what you find now is that most of your deliveries on Uber Eats, and you find, you're sitting around in traffic and then you see this guy on a bicycle, he's not cycling, then he comes pass by you, then you wonder, what is he doing? But he's actually using an electric bicycle. So these measures that we put has seen eBay, come and invest here heavily on e-mobility. So this one, in the next few months, you'll see a huge investment here on PPP, on public transport. Chairman, and that way, my CPA colleagues don't have to carry their cars to the office.
Chairman, let me hold you there. I fundamentally disagree with what you're saying, but let me come to CK for your take on this tax.
I hear what he's saying, but I think the challenge is, even from the motor vehicle perspective, we're already paying such significant taxes. So, for example, I bring in a new car. I'll pay excise tax on it because a motor vehicle is deemed to be a luxury item. Yes. I'm already paying excise tax on it. From the fuel that I consume, I'm paying excise tax, I pay VAT, I pay the road maintenance levy as I use. Chair is telling us that, for example, if I don't want to pay the motor vehicle tax, I leave my car at home. The problem is that insurance is paid mainly for a year. Yes. You get, so unlike fuel where I will say, I don't want to incur that excise tax, I won't fuel my car, I will walk to work. This other one is a bit much more difficult to actually say, I won't insure my car, and therefore I shouldn't pay. And Chair, we're looking at 2.5%. I can tell you, even for the insurance premiums from a comprehensive perspective, they're at about 5%. And many Kenyans struggle to even pay that 5%. And they even sometimes pay it in installments. And some of them actually take up third-party insurance. Yeah. So adding another 2.5%, I think, Chair, that is quite punitive. And then thinking about your rationale, and I would love if, for example, we would have a perfect commuter system, public commute system. So is this the right time to introduce the tax? Shouldn't we wait first? Let's establish the system. And then if you have a choice to use it and you decide to still use your car, you can now pay this tax. I think we've more or less jumped ahead of the gun with respect to when it should be implemented. That's my take on this.
Yeah, thanks, Julius. In addition to what Christine is saying, I think really, I think we need to rethink this proposal. One, the way it's been framed, they don't look like there are any exemptions, even for electric vehicles. So it looks like, irrespective of what car you're driving, you still have to pay this motor vehicle tax. And then Christine made the point about third-party, insurance covers. So how are we going to tax these ones? Because you generally don't have a valuation number for a third-party insurance. And also don't forget there are people who have got vehicles which are used not on roads, it's on a farm. So it never really needs to go to, so are they paying? And I'm wondering, when I read this provision, I'm just wondering, are tuk-tuks vehicles? Are boda-bodas vehicles? Should we be taxing them? And I appreciate what Mheshimiwa here is saying about encouraging investment in that sector. And I think really this is one of the conversations we should have about tax policy. And I'm very happy that he was a big champion of the national tax policy. You see, if you look at the VAT Act, we zero-rated electric buses last year. Now we are removing that.
Yes.
The bicycles, the same thing. So I'm not very clear whether how this is going to work in terms of policy consistency. Yeah? And my last point, Julian's, the maximum we are going to collect on these vehicles is probably what, 100,000. The cap. Eh? The cap. So I don't know how many cars are in Kenya, but let's assume that there are 1 million cars. So you're probably talking about 10 billion shillings in collections. When I look at road maintenance levy, we're probably collecting more. So I think, Mheshimiwa, when we come to before your committee, we'll be asking for a review of this one. Because, and the last point, Julian, sorry, we're asking insurance companies to collect this, which is fine. I mean, KRA usually uses agents to collect. But if these insurance companies don't pay, the penalty is 50%.
Yes.
That is very punitive. So that I think we probably need to rethink.
The beauty about this, and I really want Kenyans who are listening to us, we're encouraging this conversation. And the issue about, for example, electric vehicles, whether it involves boda-bodas or involves tuk-tuks, this is why they just propose us. And that's why I think in the dailies of tomorrow, you're going to see the advice of asking for public participation on this. And we're going to, and we'll neaten it so that I said a week ago that this time around, last finance bill, even though it was the most litigated, we had one of the biggest successes because we had only one clause, one section that was actually thrown out in the courts. Because all the other clauses, or the other sections now, because now an act, were well thought through and properly worded. And I said this time around, the Finance Act of 2024 is going to be crystal clear.
Yeah.
When studying the ruling of Justice Majanja, he said, Parliament has never lacked word to express itself on a matter. So by the time we finish with public participation and do a committee report and do a committee of the whole House, which I hope that the plenary agree with our recommendations, is that we'll have a crystal clear law that says that is not subject to any other interpretation. Why we say, if you're not targeting this, then not. Because one of the conventions that has also come up is on the motor vehicle circulation tax is when you pay your tax to your premiums to an intermediary, an agent. So what happens if the agent does not remit the same to the insurer? So these are all the conversations that we're having, but we're saying for a fact that we do not have enough money to maintain our roads. And we need to have our roads. We're not able to attract enough investment on our public transportation, which is where we should go. And once we make Kenya attractive for that investment on public transport, then we will not even be discussing about this, because we will comfortably take a bus or a train like they do in developed countries.
Chairman, one of my submissions that will come to your committee on this matter is what happens in the event that insurance is not taken for a full year. Will this tax obligation be prorated? I'd be very curious about that. But in the interest of time, allow us to switch gears a bit. Banking services will now be subject to VAT because there's a cleanup of the first schedule of the VAT Act. Let me start with Chairman very briefly here, because when banking services were slapped with excise, the argument was that they are not vatable anyway. Now we want to subject them to VAT and excise. And for a government that has really touted itself as being pro-formal financial inclusion, where do you stand with this?
First of all, let me talk about what is the objective of this.
Yeah.
We are in 2021, 2022, we incurred 393.6 billion shillings in tax expenditures. So 333 billion shillings in tax expenditures. Imagine how much quantum is that. It's almost the equivalent that we are raising. It's almost the equivalent of the revenue raising measures we have in the new in the proposed finance bill. And we're saying we cannot be spending this amount of money. And we're asking ourselves, where is this money being spent on? Where can we have savings? And where can we now make sure that we still have ease of doing business, we're still able to collect revenue, but we do not have to spend, because the tax expenditures really, if you look at it from a layman's perspective, is using taxpayers' money to fund these particular operations. And we're saying, do we need to do this? The question that we are asking ourselves, and we'll be receiving submissions from the public and all these great experts in tax, is that what are maybe some of those items that we may have to rethink? But most importantly, we cannot spend 303 billion shillings of taxpayers' money on tax expenditures. It is imprudent. It is, I would say, it is also punitive to other Kenyans that are not using these particular services. And imagine the quantum of our tax expenditures is exact same quantum of all the measures we are using on this finance bill. So that is something that a conversation we must have. Then, what is the quality, what is the authenticity of the tax claims? So luckily, the ETIM system has come to help and clean that up. But one of the reasons why there is such a pushback on the ETIM system is exactly because of that. We've seen some sectors, I don't want to name them, but we've seen some sectors claim up to 35 billion shillings of tax exemption, okay, or no, of tax refunds. When we look at the quantum of the value of that sector is 45 billion.
Yeah.
So you cannot have a 45 billion industry claiming tax refunds of that 5 billion. It doesn't make sense. And now when you go towards checking on those numbers, that cost of tax administration is too high. So you end up having officers in KRA who, instead of now doing the work of the regular work, they are permanently reviewing and assessing tax refunds. Okay. We attempted even in the last finance bill, now Finance Act, to provide for that if you are seeking your tax refunds, you can net off your taxes from other tax brackets. Yeah. And even with that, now we still have people who are in perpetuity tax refund even after claiming their tax refund on other taxes. So this tells you that this is where our revenues are, this is where we have privilege of our revenues, and we must fix it.
So, Sike, the chairman is tabling the case of the quantum of tax expenditures. And just for clarity, tax expenditure is the amount of tax foregone because of exemptions and many other provisions within the law. Do you buy this argument?
I think for me the challenge is these are financial services, and as you have clearly said, when they introduced excise tax on financial services, the argument was that they are not vatable, because in essence, excise tax is supposed to be a sin tax, and there wasn't actually any form of sin when we talk about financial services. Now, let me give you the challenge that it comes with when you subject VAT to a service. Now, unlike a manufacturing plant, which would have a lot of input that was incurred, that was subjected to VAT, that would be offset, that would offset the output tax payable. For financial services, their input VAT is very little, because it's dealing with services. Their biggest cost could actually be, for example, employees, so they wouldn't have a lot of input to offset against the output. So what does that do? It forces the financial institutions to pass this cost straight to the consumer. So on one hand, we are trying to tell the consumer, I'm increasing your disposable income, but Mheshimiwa, we are taking it back on the other hand, because you're telling them, I'll give you this, but just know if you engage in that service, and most of it, I will take it back. So it really And I think that's the challenge that we are having, because these financial services, almost everyone is paying school fees, for example, through the bank.
Yeah.
You know, a common wananchi and a person who's well established. So the challenge is that 16% will be an additional cost to that consumer who we tried to increase their disposable income by allowing some deductions. I think that's the challenge it brings with it.
Robert.
Yeah, I mean, there's a good example here that Christine has given, which is whenever we are paying taxes, generally you'll pay it via RTGS. Now that transfer of money is now going to be subject to 16% VAT. I think really the big concern for businesses here is, are you sort of chasing away people from the formal channels of transacting? Exactly. Because does it then make sense for me to go and withdraw my money so that they can come and pay you in cash, so that I'm not paying these taxes? And I hear what the chairman is saying, and definitely there's a case for rationalizing our expenditure. Absolutely, no problem about that. My only request is, perhaps can we sit down and see, of these ones, which ones can we do on a phased, by using a phased approach, so that you're not all of a sudden now bringing 16% on in addition to 20% excise duty. Perhaps just a phased approach may be a bit more palatable for businesses, and I really think we must. I completely agree with him about expanding the tax base. That's the one good thing. That's the one thing that you cannot take away from this government. Yes. They have attempted to expand that tax base, absolutely. And the more people pay taxes, then possibly the more we can remove some of these proposals, so that we can, support businesses, as it were.
And when you talk about expanding the tax base, and the chairman touched on this issue of the electronic tax invoice management system, that's ETIMS. One of the provisions in the finance bill around ETIMS, and by the way, I'm on record saying I'm fully behind ETIMS. I think it's a system which this country needs. But when you provide that KRA is empowered to mandate a business to integrate its systems, but more importantly, that failure to be in compliance with that provision is a penalty of up to 2 million every month. Every month. Let me start from CK this time.
Yeah, I think what government is trying to do is get visibility of transactions, and we have seen it do it in different ways. So maybe just before I respond to that, there's a new withholding tax on goods supplied to government and public entities. And I think that has been done towards increasing the tax base and also enhancing compliance. You could have taxpayers supply to government, but they never remit the balance of the tax, yeah? Yes. So we can see government's intention to increase the tax base and to also increase compliance through the withholding tax mechanism. And I think that's what they're still doing with the integrated system. It's just that that penalty is really, really high. But that has been done in order to generate more revenue and increase the tax base.
Chairman, at penalty.
I don't think it's a point of concern, or I don't think we should be very worried about the penalty, because if you want to do the right thing,
you wouldn't be worried about it. You
shouldn't be worried. So the people that are worried about this penalty are the ones that are cheating on our taxes. So really, it's like arguing the life imprisonment penalty for murder is too stringent, that you should be, because really, and what is really, really unfortunate is, we have a lot of briefcase companies, especially in the good that Christine mentioned, these out, especially the ones that do business with government. There are people who their job is just to win government tenders, and then they just sell that business to someone else, and that money gets to the market. You can see it, you can trace it, and that's why we are saying now, when you supply a product or service to government, there's a withholding tax. So that withholding tax, remember, is claimable when you pay the final tax. But you're saying now that there's a withholding tax, the taxman asks, so you seem to have supplied something there. Why are you declaring zero returns? Why is the installment tax? And all this, because the saddest thing, gentlemen and lady, is we have 20% of Kenyans paying taxes for 80% of the population. And if everyone would pay their fair share of tax, we wouldn't have to have all these we wouldn't have to have all this array of taxes for everyone. I'll give an example. Even when you reduce the turnover tax, people are saying, no, I only make an income of 1,000 shillings a day. Do you know that a teacher an ECD teacher or someone who is earning 30,000 shillings a month actually gets to pay payee tax. And their work is no, business is difficult, it's not like being employed. Think about nurses, who are employed in private hospitals, in ICU, doing all the difficult job. Think about the ECD teachers who take care of our little ones, cleaning them up and doing all that. They are paying their fair share of tax.
Yeah.
But you have all these now big corporations and businesses, and because of Kiingereza Mingi and the experts in tax language, then they don't want to pay their share of tax. That's what you have a problem with. And you say, if only we get everyone to pay their rightful share of tax, we will all live happily ever after.
but Chairman, respectfully to disagree with the point that you're raising, and my issue with that penalty is this. If you look at KNBS data, 7 out of every 10 businesses in this country are either micro or small, right? The large businesses are already integrated with KRA systems. They don't have a problem. But these micro and small businesses, for whom integration is a painstaking exercise, you are leaving them to the whims of a provision where the penalty is too steep. You can argue that they are briefcase companies, and they're there for sure. But the bulk of businesses that exist are actually legit businesses, which will now be affected. I can assure you, the folding of businesses because of this provision is very serious.
Okay. Again, this is the beauty of public participation, this is the beauty of public debate. It's something that we will be willing to look at when we're faced with the facts, and this is what it is. And therefore, like for example, even when we passed the Finance Act now on the provision of having everyone registered on e-teams, we had the KRA after now listening to and implementing it and seeing the challenges and the advantages and the design of the system, further issuing regulations. And say, for example, if you're earning this much or this, and even introducing, before previously there was no USSD code. Yes. Now even introducing a USSD code as a way of accessing e-teams. We hide behind this narrative that Kenya, that some technologies are not there for MSMEs. But I dare say, Kenya is a leader in Africa actually, and ranks quite highly globally in terms of use of technology. Yes, we have our use of mobile payment is bigger than that of America. Like the percentage use of a population that use mobile payments is much higher than economies and like Excise
now is going up
like the US. So that person in the village. Now, we're having a discussion with some people from Safaricom the other day and saying, nowadays, even if you try to scam an old lady or an old man in the village and telling them to share with you their M-Pesa pin, they say, "Apana, wewe ni mkora." So even that old person in the village, a literate person, can use such a fairly complicated or fairly technical app like M-Pesa. So the same way you're saying, if we're able to simplify e-teams, in a way that it's not about a software, it's not about Excel sheets, it's about a simple system. I'm selling you this, or these are my sales for the day, star, hash, this is it, and I issue you with you an electronic invoice or an electronic receipt. It will go a long way in expanding the tax base. And that is what we're saying. If only we have everyone, and I mean everyone, paying their fair share of tax. And that's where we want to go to. Because the reason why there is a lot of outcry, for example, from salaried people is the previous tax measures seem to have been targeted to people who are already paying their fair of tax, which the easiest, of course, was the employed people, because you have the employer and you have the employee. But you have people here who are making a lot more on the side, but they're not on the tax bracket. And when you ask them, they say, but I'm paying VAT. Yes. But unfortunately, even the ones that are employed are actually paying their VAT and their excise. So once we're able to expand this tax, have everyone on board, I'm looking for a situation where we will actually even be able to reduce our tax rates.
Okay. Let me come to Robert. Section 14 of the Excise Duty Act. I've received a lot of concerns from manufacturers around what that provision with regard to the inputs means. If you could just explain it to us.
Okay, thanks for that, Julius. So Section 14 of the Excise Duty Act is the one that permits manufacturers to claim the excise that they incur when they're manufacturing their product. So if you're talking about, for example, somebody who's manufacturing beer or spirits, if they incur, if they buy ethanol, that ethanol is subject to excise. And now that excise is you are allowed to knock it off against the excise that you charge whenever you sell this product. So it really assisted the manufacturers to sort of manage their cash flows, because yes, I'm charging you when I sell you the alcohol, but I'm also incurring an input excise on this other side, but I'm allowed to net off and I pay you the difference. So really that was the issue. Now, I know, my good friend Christine here is very passionate about that issue of, can we look at this section and expand it so that it's just not the raw materials, it includes the packaging, for example, because some of this packaging is subject to excise. And really that's what the industry was hoping. However, now the finance bill, which is really a proposal, and I think it's important to clarify that this is a proposal, what it does is that it proposes to delete that entire section. Yeah. What it means for you as a manufacturer is that you can no longer, you'll incur the input VAT on your ethanol, but you can't claim it. Yeah. Which means, excise. And that makes it a little bit more expensive. Your product becomes more expensive. And don't forget, excise is levied before you levy VAT. So there's a compounding impact. So really that's, and this is why we're talking about the national tax policy and how we can align to it, because we want to move manufacturing to about 15% of our GDP. But now, will this proposal encourage manufacturing, or will it lead to actually a contraction of that sector?
Okay. Sike.
Yeah, maybe just to build on that, Julian's, consumption taxes, which are mainly indirect taxes, VAT and excise, should not be borne by the company. It's actually a final tax. It's a consumption tax. Yeah. It should be borne by the final consumer. In essence, when you look at VAT, there's always an offset between output VAT and input VAT. Yeah. So the input that you incurred in creating that output VAT is allowed, or as an offset, as a credit. Now, with excise tax, as my colleague said, Section 14 actually stated that taxpayers will be allowed a credit on raw materials. Yeah, we have really been engaging government to expand that to include packaging material, and this was mainly driven by the introduction of excise tax on packaging material. So for example, glass bottles, plastics are subject to excise duty, and this is an issue that has been litigated in court before, and our plea was for them to expand. So when we looked at the bill and we saw that provision was deleted, we actually moved from the frying pan into the fire. Because that, as my colleague said, it compounds the tax. Therefore, what it does is that it increases the cost of production for the manufacturing business. And this has not just been done on manufacturing only, it has actually also been done on internet, but data. Yes, because into the guys who debug the internet, what they do is that they are allowed to claim the credit they paid, the excise tax they paid to Safaricom, and then when they when they sell, they charge the excise tax. So there's usually an offset. Even that provision has been removed. We are making excise tax extremely punitive, and what we are saying is that it will be good to just have a revision of that provision so that we ensure that we are in line. And actually, if you look at the medium-term revenue strategy and the national tax policy, one of the policy guidelines under excise tax is that being a consumption tax, we should have the automatic offset of any raw materials or products that were used to manufacture the final excise product. Okay. Yeah.
Chairman, do you want to chime in, or I give you another point to...
I share the views of my ISPAC colleagues, but again, the same thing that I said earlier. How do we make sure that these provisions that lead to these tax expenditures are not subject to abuse? And that's why we're saying this 393 billion shillings we spent on tax expenditures, we looked at where are we spending on. And it was the exemption status, it was the claim of those excise duty, it was the claim of those VAT, and you're saying we need to have sobriety along this sector. And now, and I'm really hoping that now, when everyone is now embodied on e-teams, then in future, then it will be possible to review it. But as we speak, I give this example. So one day I'm in the constituency and I give a lift to one of my friends, and then I realized that my vehicle is low on gas, so we go to a petrol station to buy fuel, and then I say, weka mafuta. Then once the attendant fuels, I pay via M-Pesa. Then the guy says, wait, can I get a receipt? I'm like, so why do you need a receipt for my car for the fuel that I bought? He says, unajua hii receipt inatusaidia kwa returns ya KRA. So and actually that receipting business is a huge business. Yeah. Like it's huge, where when you don't pick your receipt when you have a meal at a restaurant, or when you fuel a car, whatever it is, or you buy things and you do not insist on an ETI receipt, or you take and throw it in a dustbin, there is a business of someone collecting it and going to use them for claiming these taxes. So the essence of this is not to punish manufacturers. It's just to clean up on our tax expenditures. And once now we're able to clean that up, then we'll be able to say these are now genuine tax expenditures that we think are going to spur manufacturing. And especially, let me repeat, when everyone is embodied on e-teams, then it becomes an easier conversion to do and have it. And even recognizing the import of this is now the exemption you've given out to tea packaging materials, because that was not there just there in the current Finance Act. Now we provided for that because we realized that even if we want to produce, and I had His Excellency the President today talk about that's quite unforgiving that Kenya does not have any tea brand that they export. You know, all our tea brands are actually foreign brands. And why is that? Because even though we're growing the tea, but the packaging of it is now too expensive that for us to package here and export for a local market. So we're now providing for that a tax incentive now for tea packaging materials, and also we'll add now for coffee packaging materials, so that we can have now our own tea and coffee packaged here in Kenya for export.
Friends, our time is quickly dialing out, but let me ask a question which every Kenyan has discussed. The provision regarding KRA and the data protection, exemption from constraints to be able to access data where there's a need for tax compliance. So much discussion online about it. Robert, what do you make of this?
Yeah, I mean, so the proposal is to allow KRA to be one of the exempted entities in terms of accessing this data, just like security organs are permitted to access this data for national security purposes. I think for me, it's not really a big issue. And the reason why I say it's not a big issue is, one, we've seen KRA already integrating or proposing to integrate with most of the businesses. Two, there's a lot of reporting from, for example, the Common Reporting Standards, we call it CRS, where banks are required now to disclose this data. And anyway, even under the Tax Procedures Act, if KRA wanted your data, the only thing that they need to do is write to the person who is holding your records, and under the Tax Procedures Act, they are entitled to get that data. So I think it's really just a question of addressing the legal challenge of them accessing that data. But otherwise, under the Tax Procedures Act, they'll go to my bank and say, give me details of Robert's bank account. Yeah. And I've refused to give KRA, but they'll still get it, and they'll come and tell me, you thought that we would not get it. So under the Tax Procedures Act, it's still there. But I know it's a sensitive issue because a lot of us are asking, so what about my M-Pesa statements? What about my banks? Am I going to start transacting from a cash perspective? Yeah, so that's really a public concern.
It's okay.
Yeah. No, I think where this would happen because we're on a self-assessment. It is me who says, this is my income, here is my tax. Now, my only challenge is when, I think there should be some mechanisms or some regulations as to when that should be done. You get, so that it's not at all instances. It should be in instances where, for example, the Revenue Authority feels that I'm not declaring my rightful share of tax, and maybe an investigation or an audit is being done. Because sometimes, Julians, you will get information being requested from the Revenue Authority, and you send your M-Pesa statements, they look at any inflows and they issue you a pre-assessment stating that those the inflows are actually income, and maybe you are raising money for a wedding, or you are raising money for, yeah, so it becomes very complicated to start having that conversation. But I think also with e-teams, because of the kind of information that e-teams requires, I mean, the details, the PIN numbers, the service that is being provided, yes, it was critical for them to do that, because a lot of suits would have been filed. Yeah, because if you look at what e-teams requires you to provide, it is quite much from a data perspective.
All right, Chairman.
You know, I like the conversation about contributions you receive for weddings and funerals and all, but those are more of exemptions that they are out of the norm, because we had a presentation by KRA this week. And actually, the P2P transaction, the person-to-person transaction on M-Pesa, almost tripled in the last 8 months. You know, with the introduction of e-teams now, and saying that we're now going to look, and the media reporting that the Tax Procedures Act is now allowing KRA to ask for M-Pesa statement and look at it. People are now saying, usitume kwa paybill, niwekee kwa M-Pesa.
Send money.
So I think it is a guilty one that should be afraid, because and by the way, I dare say KRA does not have the capacity to check the M-Pesa statements of all the M-Pesa statement holders. They don't have capacity to check all the bank transactions of everyone. So what they will do is that additional assessment is when they feel that there has been this particular taxpayer, there was a withholding tax that was reported on that PIN. There was an e-teams invoice that was invoiced from this person, and yet they are declaring zero return. So something is not adding up. So that's where KRA will come and investigate and say, so can I have your bank statement? Can I have your M-Pesa statement? And also when now you go for review, where you probably issued your self-assessment, and the authority feels that you have under quoted really your revenue, they'll say, fine, can we see your bank statements on this transaction? Can we see your M-Pesa transaction? So if you are paying your fair share of tax, you really should not be worried. But of course, if you are the one who says, usitume kwa paybill, tuma kwa M-Pesa, then you should really be worried, because now they have access to that information. And also, the move is also aimed at to be also aligned in law. Because I think the government is very clear that they don't want to break any law. So where then a time when you didn't know whether someone was spying on you or when someone or not is long gone. So the requirement of, and by the way, it's even happening now, because that's why even the authority is able to issue an agency notice on your bank account and stop transactions on your bank account. But saying, can they do that with the provisions of the law? And can we have now everyone, because let me put a different perspective of what this means to competitiveness in business. Taxes, VAT is 16%. So if I evade my 16% VAT, my product will be 16% cheaper. And 16% cheaper is not something small. Think about the construction sector. Think about if you're going to buy construction materials in hardware. Goods worth 100,000 shillings, which will be quite something that a small, let me call it a small mujengo would take in terms of the mawe, the mchanga, the simiti, and the chuma. Then the one who is tax compliant will charge you 116,000. So that 16,000 extra is enough for you to pay your labor for the week. So you have one hardware here who is selling the same items for 116,000, and another one here who is selling for 100,000 shillings. So you, who is tax compliant, who have made your investment, then you're losing out on the competitiveness in business. Let's not talk about when sales are bigger, like 1 million shillings. You're talking about a difference of 160,000 shillings. And that is why you've seen some businesses close, especially the ones that want to do legitimate business and do business according to the laws of the land, which is what we must stop.
Okay. My director tells me we have 3 minutes to go, so let me do this. Let's take our round of closing remarks. And as you do that, thoughts on the eco-levy. Robert, let's start with you.
Eco-levy. And this is really why Kenyans are saying, guys, let's take a step back because we think we're being taxed too much. Because you see, if you think about it, most of these products are being imported. So like Christine says, you're paying customs duty, you're paying excise, you're paying VAT, you're paying RDL, Railway Development Levy, you're probably paying import declaration fee, and now you're going to be paying eco levy. Not to mention if you are importing some of the things that are in the third schedule for the miscellaneous, so you're going to be paying investment promotion levy. So I mean, it's quite a lot of tax to be paid. But what I would say is that, you know, like we started by saying, this finance bill, a big win for employees, especially people who've got employment income. Certainly, some provisions that I think we should have a national debate about in terms of some of these proposals, and probably come to a consensus where we say, okay, guys, we hear you. Let's defer the implementation of this, or let's have a look at how this one is implemented, because some of these proposals, they came into force as late as 1st September 2023. Now we're proposing to change them. So you see, even for a business, that becomes a challenge. So I think we have that good conversation, and I'm very happy that the chairman has invited people to make comments, and I'm sure they will listen to them. Thank you, Julian.
Sike.
Yeah, so I actually am very, it's very good to see the intention to increase the tax base, but we must actually do it in a way that does not kill the business, because all the systems are interlinked. I mean, for the success of the individual, for them to get a salary, the manufacturing company must be thriving. Okay, for us to increase the disposable income, we need to ensure that the end product is not so expensive such that this person that we were hoping would afford this product still cannot afford the product. It has to be a balance. And as my colleague said about predictability, I think that's one thing that we should try to, as much as possible, implement. The National Tax Policy speaks about it, the MTRS speaks about it, but when you look at the finance bill and you look at the excise tax changes, data goes back from 15% to 20%. Yeah. Money transfer from 15% to 20%. You know, that a bit, it worries me, because I'm wondering, imagine a business that just set up knowing that this is a tax. It's not even a year later that has actually changed. And excise is an area that has really changed, Julian's, because prior to the Excise Duty Act 2015, excise was mainly from an ad valorem perspective. After 2015, it moved to a specific rate. Now we are actually dealing with the issue, the content that is causing the negative externality. It is indeed a good move, because we are saying that's the problem. Let's tax the problem. Let's not just tax the entire product. So those are definitely good developments. We just need to review that to ensure that the businesses still continue to thrive. Sustainable taxation for me is critical. Yeah. We should be able to ensure that yes, we are paying taxes, but the business still exists.
Chairman, you have a minute for your closing submission.
You know, when you had a similar conversation last year, we were told the economy will collapse. Jobs will be lost. We're not going to raise any revenue. What you've seen is, for example, just between July and November of last year, we had an increase of 120 billion shillings in terms of tax collection. What did that money do? That money was able to reduce the cost of fertilizer from 6,500 to 2,500. That money was able to recruit 46,000 teachers. That money was used to provide funding for a junior secondary school that was at limbo at that particular time. That money was used to give more yield to or better prices to our coffee farmers. That money was used to provide drying silos for our maize and prevent post-harvest losses. That money was able to spur our manufacturing sector and consequently reduce our balance of trade, you know, from 7.8% to 5% to 5% in 2023 to 5% in 2024. Those measures were able to have our Nairobi Securities Exchange being voted as one of the best, in the region. We had our government bond being oversubscribed. We were able to reduce the exchange rate and have a pressure of the shilling from 165 to 135, consequently saving us 1 trillion shillings as in our external debt. And this time around, the same measures, when you have the same discussion next year, we will have a better confidence saying, this is good, and this is good.
But Chairman, we are far behind our revenue targets if you look at KRA numbers. But nonetheless, we unfortunately we have to close it at that point. Chairman is insisting we have a year-on-year growth, and therefore it still needs to be clapped for. We will continue covering matters regarding finance bill. We definitely cannot cover it exhaustively in one sitting. So next Tuesday on Business Redefined, we shall have the same discussion now that the public participation will have kicked off and illuminate other issues of this interest.